Did you know that in 2026, the IRS is implementing a major rule change that could completely transform the financial lives of seniors and immigrants? If you remain unaware of these changes, you could end up losing thousands of dollars. Today, we're going to tell you everything you need to know to protect your hard-earned money and stay compliant with the new regulations. Hello, everyone, and welcome to U.S. Immigration Intel. I'm your host, and today we're diving deep into a critically important topic that will affect your financial planning in 2026 and beyond. If you're a senior citizen or if you're living in the United States as an immigrant, this video is absolutely essential for you. Here at U.S. Immigration Intel, we always bring you authentic and updated information so you can make better financial decisions while living in America. So let's get started and understand exactly what these IRS rule changes are and how they will impact your life. The Internal Revenue Service, commonly known as the IRS, makes changes to tax rules every year, but the 2026 rule changes are particularly significant for seniors and immigrants. These changes affect everything from standard deductions to filing requirements, from retirement account distributions to foreign income reporting. Understanding these changes now will give you plenty of time to adjust your financial strategies and potentially save thousands of dollars in taxes. Let me break down these changes in detail so you can fully understand what's coming and how to prepare for it. First and foremost, let's talk about the standard deduction changes for 2026. The IRS has increased the standard deduction amounts to account for inflation, which is actually good news for most taxpayers. If you're filing as a single individual, your standard deduction will increase to $15,900. For married couples who are filing jointly, this amount jumps to $31,800. If you're filing as head of household, your standard deduction will be $23,900. This increase in standard deduction is significant because it reduces your taxable income, which means you'll pay less in federal income taxes. For many middle-income families and retirees, this change alone could save several hundred in taxes. But here's where it gets even better for seniors. If you're 65 years of age or older, you qualify for an additional standard deduction on top of the regular amount. In 2026, this additional amount will be $2,000 for single filers and head of household filers. For married couples, each spouse who is 65 or older gets an additional $2,500. This means if both you and your spouse are over 65, you get a combined additional deduction of $3,000. When you add this to the regular married filing jointly standard deduction, a senior couple could have a total standard deduction of $34,800. This is a massive benefit for seniors who are living on fixed incomes from Social Security, pensions, and retirement savings. Now let's discuss the tax bracket adjustments for 2026. The IRS maintains 7 tax brackets that range from 10% at the lowest end to 37% at the highest end. These brackets are adjusted annually for inflation to prevent what's called bracket creep, where inflation pushes people into higher tax brackets even though their real purchasing power hasn't increased. For seniors and immigrants, understanding where your income falls within these brackets is crucial for effective tax planning. For example, if you're a retiree taking distributions from your traditional IRA or 401k, these withdrawals are taxed as ordinary income. By carefully timing and sizing these withdrawals, you can potentially stay in a lower tax bracket and keep more of your retirement savings. Similarly, if you're an immigrant with income from multiple sources, including wages, business income, or foreign income, knowing the bracket thresholds helps you plan deductions and credits more effectively. For immigrants specifically, there are several important considerations regarding filing status and residency rules. If you hold a green card or if you meet the substantial presence test, you're considered a U.S. resident for tax purposes and must report your worldwide income to the IRS. The substantial presence test is a calculation based on the number of days you've been physically present in the United States over a 3-year period. In 2026, the IRS is enhancing its systems to better track and verify foreign income and foreign account holdings. This means the agency will have improved capabilities to detect unreported foreign income or undisclosed foreign bank accounts. Speaking of foreign bank accounts, if you're an immigrant and you have financial accounts outside the United States, you need to be aware of the FBAR requirements. FBAR stands for Foreign Bank Account Report, and it's required if the aggregate value of all your foreign financial accounts exceeds $10,000 at any time during the calendar year. This isn't just about bank accounts. It includes investment accounts, mutual funds, and even accounts where you have signature authority. The penalties for failing to file FBAR can be severe, potentially reaching 50% of the account balance for willful violations. With the IRS's enhanced monitoring systems in 2026, there's a higher likelihood of getting caught if you fail to report. So compliance is more important than ever. Let's talk about Social Security benefits and how they're taxed, which is particularly important for seniors. Many people don't realize that Social Security benefits can be partially taxable depending on your other income. The IRS uses something called combined income to determine how much of your Social Security is taxable. Combined income is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If you're single and your combined income exceeds $25,000, up to 50% of your benefits may be taxable. If it exceeds $34,000, up to 85% may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000, respectively. In 2026, the IRS is being more stringent about ensuring proper reporting of Social Security income and accurate calculation of the taxable portion. If you think your benefits will be taxable, consider having taxes withheld directly from your Social Security payments or making quarterly estimated tax payments to avoid a large bill at tax time. Retirement accounts are another area seeing significant attention in 2026. Under the Secure 2.0 Act, the age for required minimum distributions, or RMDs, has been increased to 73. This means once you reach age 73, you must start taking minimum distributions from your traditional IRAs and 401k accounts each year. The amount you must withdraw is based on your account balance and your life expectancy according to IRS tables. If you fail to take your RMD, or if you take less than the required amount, the penalty is steep at 50% of the amount you should have withdrawn but didn't. For example, if your RMD was $20,000 but you only took $10,000, you'd owe a $5,000 penalty on the $10,000 shortfall. In 2026, the IRS is implementing better tracking systems to identify individuals who miss their RMDs, so compliance is critical. Planning your RMDs strategically can help minimize taxes. For instance, you might consider taking distributions earlier in retirement when you're in a lower tax bracket. Or you could explore Roth conversions during low-income years. For immigrants who are still navigating the U.S. tax system, tax credits can provide significant relief. The Earned Income Tax Credit and the Child Tax Credit are two major credits that can substantially reduce your tax bill or even result in a refund. The Earned Income Tax Credit is designed for low to moderate income workers and can be worth several thousand depending on your income and number of children. The Child Tax Credit provides up to $2,000 per qualifying child under age 17. In 2026, both of these credits have been adjusted for inflation and the income thresholds have been updated. To claim these credits, you must meet specific requirements, including having a valid Social Security number for yourself, your spouse, and any children you're claiming. You also need to have earned income from employment or self-employment. Proper documentation is essential. So keep records of your income, your children's information, and any childcare expenses if you're also claiming the Child and Dependent Care Credit. Healthcare costs and Medicare are major concerns for seniors, and there are important tax implications to understand. If you're enrolled in Medicare Part B and Part D, your premiums are based on your income from 2 years prior. This is called the Income-Related Monthly Adjustment Amount, or ERMAA. If your modified adjusted gross income exceeds certain thresholds, you'll pay higher premiums for your Medicare coverage. For 2026, these income thresholds have been updated. For single filers, the base threshold is around $103,000, and for married couples filing jointly, it's around $206,000. If your income exceeds these amounts, your premiums increase on a sliding scale. The highest income earners can pay several hundred more per month. This is why income management in retirement is so important. Strategies like Roth conversions, timing of capital gains, and careful management of IRA distributions can help keep your income below the thresholds and save you thousands in Medicare premiums over time. Estate planning and gift tax rules are also evolving, which is particularly relevant for affluent seniors and immigrants who want to transfer wealth to the next generation. The federal estate tax exemption for 2026 is approximately $13 million per individual, or about $26 million for a married couple. This means if your estate is worth less than these amounts, your heirs won't owe federal estate tax. However, it's important to note that some states have their own estate or inheritance taxes with much lower exemptions. States like Massachusetts, Oregon, and Washington have exemptions starting at $1 million or less. If you live in one of these states, state-level estate planning becomes crucial. Additionally, current law sunsets at the end of 2025, which means the federal exemption could be cut in half in 2026 unless Congress acts to extend it. For individuals with substantial estates, this creates urgency around estate planning strategies like gifting, trusts, and charitable donations. Documentation and record-keeping have become increasingly important, especially for immigrants reporting foreign income or claiming foreign tax credits. The IRS expects taxpayers to maintain detailed records supporting all income deductions and credits claimed on their tax returns. This includes W-2s, 1099s, receipts for deductible expenses, documentation of foreign income, and proof of foreign taxes paid. If you're claiming the foreign earned income exclusion or the foreign tax credit, you need documentation showing your foreign residence or physical presence, as well as detailed records of your foreign income and any foreign taxes you paid. In the event of an audit, which can happen randomly or be triggered by certain red flags, you'll need to produce this documentation quickly. The IRS generally recommends keeping tax records for at least 3 years, but 7 years is safer for most situations. Establishing a good record-keeping system, whether digital or paper-based, can save you tremendous headaches if you're ever audited. Filing deadlines are another critical aspect that everyone needs to understand. For most taxpayers, the deadline to file your federal income tax return is April 15th of each year. However, if you're living abroad, you automatically get a 2-month extension to June 15th, though any tax owed is still due by April 15th to avoid interest charges. You can also request a standard 6-month extension, which moves your filing deadline to October 15th. However, it's crucial to understand that an extension to file is not an extension to pay. If you owe taxes, they must be paid by the original April 15th deadline. Otherwise, you'll accrue interest and potentially face late payment penalties. For seniors taking RMDs, the deadline is December 31st for most years, though your first RMD can be delayed until April 1st of the year following the year you turn 73. The IRS has significantly increased its enforcement capabilities in recent years, and this trend continues into 2026. The agency receives substantial additional funding to enhance technology, hire more auditors, and improve compliance programs. This means there's a higher likelihood of audits, especially for high-income taxpayers, those with complex international transactions, and those claiming certain credits and deductions. The consequences of non-compliance can be severe, ranging from accuracy-related penalties to fraud penalties, interest charges, and in extreme cases, criminal prosecution. However, the IRS also recognizes that honest mistakes happen. If you discover an error on a previously filed return, you can file an amended return using Form 1040X to correct it. Being proactive about fixing mistakes demonstrates good faith and can help minimize penalties. Given the complexity of the tax code and the significant changes coming in 2026, seeking professional help is often a wise investment. Certified public accountants, CPAs, enrolled agents, and tax attorneys specialize in tax planning and compliance. A good tax professional can help you navigate complex situations, identify deductions and credits you might have missed, ensure compliance with reporting requirements, and develop strategies to minimize your lifetime tax burden. While there is a cost to hiring a professional, the savings and peace of mind they provide often far exceed their fees. This is especially true if you have a complex situation involving foreign income, substantial retirement accounts, business income, rental properties, or significant investment portfolios. Don't forget about state taxes, which can vary dramatically depending on where you live. Some states like Florida, Texas, Nevada, and Washington have no state income tax at all, making them attractive for retirees and high-income individuals. Other states like California, New York, and New Jersey have high-income tax rates that can exceed 10% for top earners. Some states tax Social Security benefits, while others don't. Some states have favorable treatment for pension income or retirement account distributions. If you're retired or approaching retirement, the state you choose to live in can have a significant impact on your overall tax burden. Many retirees strategically relocate to low-tax or no-tax states to preserve more of their retirement income. So those are the major IRS rule changes and considerations for 2026 that seniors and immigrants need to understand. The key takeaway is that staying informed and taking a proactive approach to tax planning can save you substantial money and help you avoid costly mistakes. Every individual's situation is unique, so generic advice doesn't apply to everyone. Take time to understand your specific circumstances and don't hesitate to seek professional guidance when needed. Tax laws are complex and constantly evolving, so making the commitment to stay updated is one of the best financial decisions you can make. I hope today's video has been helpful and informative for you. If you found this information valuable, please give this video a like and don't forget to subscribe to US Immigration Intel so you continue receiving important updates like this. Hit that bell icon too so you get notified whenever we upload new content. If you have questions or if there's a specific topic you'd like us to cover in a future video, please let us know in the comments section. We love hearing from you and your feedback helps us create content that truly serves your needs. And please share this video with your friends and family members who are living in America because this information could be just as important for them. Here at US Immigration Intel, we're committed to providing you with all the important information you need about living in America. Take care and see you in the next video.